Imagine this. You're finally done with work life. You've clocked out for the last time and you're ready to enjoy your golden years. But then, you're introduced to a new boss. Taxes. Not your everyday payroll taxes, but a complex labyrinth of retirement taxes. This is exactly where our friend John finds himself. John, like many recent retirees, thought he had left the world of deadlines and paperwork behind. But he soon realized that retirement is not an escape from the tax man. In fact, it's quite the opposite. John now faces a new set of tax obligations, and they're not as straightforward as he had hoped. Navigating through the maze of retirement taxes can feel like a full-time job. It's a common struggle for many retirees, just like John. The paperwork, the deadlines, the uncertainty, it can all be overwhelming. But don't worry, John's struggle with taxes isn't a life sentence. There are strategies to make this process easier. Please click the like button and subscribe to this channel. First things first, understanding your tax bracket. This might sound like a no-brainer, but it's crucial. Your tax bracket determines what percentage of your income goes to the government. It's like a sliding scale, and the more you earn, the higher the percentage you pay. Let's take John's story as an example. John, a hardworking individual, was paying more taxes than necessary simply because he didn't fully understand his tax bracket. He was under the impression that he was in a higher bracket and was surprised to learn he could have been keeping more of his hard-earned money. Once he understood his correct tax bracket, he was able to adjust his tax planning strategy accordingly, which significantly reduced his tax burden. The moral of John's story? Don't underestimate the importance of understanding your tax bracket. It's not just about knowing what you owe, it's about making informed decisions for your financial future. Knowledge is power, and understanding your tax bracket can save you a lot of money. Next up, consider Roth conversions. Now this might sound complicated, but it doesn't have to be. A Roth conversion comes into play when you take a traditional individual retirement account, or IRA, and convert it into a Roth IRA. So why do this? Well, with a Roth IRA you pay taxes up front, but then all future withdrawals are tax-free. That's right, tax-free. This can be a significant advantage for those who expect to be in a higher tax bracket during their retirement years. Let's take John for example. John converted his traditional IRA to a Roth IRA. He paid taxes during the conversion, yes, but now during his retirement he's enjoying tax-free withdrawals, and it's made a world of difference in his financial planning. So, could a Roth conversion work for you? It's certainly worth looking into. Remember, a Roth conversion could be a game changer for your retirement tax strategy. Let's move on to health savings accounts. Health expenses can be a significant burden in retirement, but a health savings account can help. Now, you might be wondering, how is a health savings account a tax-saving strategy? Well, let's consider the case of our friend John. John, like many of us, was concerned about his health costs in retirement. So he decided to leverage a health savings account. He contributed pre-tax dollars to it, which reduced his taxable income. In addition, the growth in this account was also tax-free. When he retired, he had a nest egg to cover his medical expenses, all while reducing his tax liability. And here's the best part. John didn't have to use the funds strictly for medical expenses. He could also use them for other retirement costs, which further enhanced his financial flexibility. Any non-medical expenses used from an HSA is subject to tax. So health savings accounts are not just for medical expenses, they can also be a tax-saving tool. Next, we have maximizing standard deductions. It's a simple yet effective strategy. When it comes to managing your tax obligations, every little bit counts, and standard deductions are no exception. These deductions essentially reduce the amount of your income that's subject to tax, which in turn reduces your overall tax bill. Let's consider a fictional retiree named John. John managed to significantly reduce his taxable income by making the most of his standard deductions. By taking advantage of deductions available to him, John was able to lower his taxable income and, as a result, his tax obligation. This is a clear example of how maximizing standard deductions can be a game changer in your retirement tax planning. Remember, every dollar you can deduct from your taxable income is a dollar less you'll be taxed on. It's worth taking the time to understand what deductions are available to you and how you can maximize them. Maximizing standard deductions might be simple, but it's a strategy that can save you a lot in taxes. Last but not least, plan for required minimum distributions. This is something many retirees overlook. So, what are required minimum distributions, or RMDs? Well, these are the minimum amounts you must withdraw from your retirement accounts annually, starting the year you turn 72. age 73 if you reach age 72 after December 31st, 2022. Now, why should you plan for these? Because these withdrawals can push you into a higher tax bracket if not managed well. Let's take John as an example. John began planning for his RMDs several years before he hit 72. By taking calculated distributions each year, he spread out the tax impact, avoiding a sudden jump into a higher tax bracket. This strategic planning saved John from a hefty tax bill in his golden years. So keep an eye on your retirement accounts. Start planning early and consider working with a financial advisor to calculate your RMDs effectively. Remember, planning for required minimum distributions can help you avoid unexpected tax bills in retirement. So there you have it. These are the top 5 strategies to reduce your tax burden during retirement. Let's quickly recap. First, understanding your tax bracket can help you plan your withdrawals and save on taxes. Second, considering Roth conversions can provide tax-free income during retirement. Third, leveraging health savings accounts is a triple tax advantage that can significantly reduce your tax burden. Fourth, maximizing standard deductions can help you lower your taxable income. And finally, planning for required minimum distributions can help avoid hefty penalties. These strategies are not a one-size-fits-all solution, but a tailored fit for each individual. It's never too early or too late to start planning for your retirement. The sooner you start, the more time you have to grow your nest egg. Remember, the key to a stress-free retirement is planning. Start implementing these strategies now for a financially secure future. Thanks for watching, and don't forget to like and subscribe for more financial tips.